Hi guys, welcome to episode 5 of You and Your Money. Today we're talking about borrowing and loans. Borrowing is when you receive money for a specific period of time, then you have to pay it back. The money borrowed is called a loan, and the person who loans it to you is called the lender. Now, you can borrow money because we all need to borrow from time to time in order to grow. We borrow money to buy a house, and that's called a mortgage. You can borrow money to grow your business. You could also borrow money to manage day-to-day expenses when the money that you're expecting hasn't come. And people borrow to pay for large unforeseen expenses such as a death or an illness in the family. All these are reasons to borrow, but be careful. As much as you can, make sure the money that you're borrowing is for productive things that bring you money, like a business or to get better skills. Don't borrow for things just for enjoyment, like designer clothes and expensive lifestyle. You may end up paying back the loan long after you've enjoyed the benefits of what you spent the money on. When you take a loan, it's important to ask yourself, can I pay back the money comfortably? How much am I being charged for the amount of money I want to borrow? Is what I'm borrowing the money for really worth it? Am I going to make good use of the money? And when you've answered these questions and are ready to borrow, there are sources you can borrow money from. First, you can try your friends and family, then a savings group or your employer. You could also borrow money from the person who you're buying your products or services from by promising to pay them back after you've made the sale. And finally, you could borrow money from licensed financial institutions such as deposit money banks, microfinance banks, or development banks. Each lender has their own terms and conditions. They would charge you interest on the money you've borrowed, but some people might charge the interest monthly while another lender charges it yearly. And interest is the amount of money you pay, usually a percentage of the money borrowed, that you have to pay back to the lender. So if you borrow 1,000 and your interest is 10%, when you pay it back, you've got to pay the 1,000 plus 10%, which is 100, making it 1,100. You have to find out if your lender is going to charge you interest monthly or interest annually, because they are very different things. Some lenders may also charge you administrative fees or penalties. It is good to find out what the total cost of the loan is. At the time you want to take out the loan, ask them what the total amount of money you'll be paying back would be, and that would help you if you don't understand the interest charged daily and monthly. To get a loan from a financial institution, you will be asked for security or collateral. This is something that you own that the bank will keep if you don't pay back the money. They can also ask for a guarantor, which is someone who will guarantee that you pay the money back. That way, if you don't pay the money back, that person has to pay the money back. If you're asking for a business loan, they might ask you for a business plan. If you want the loan to buy a house, they'll ask you for the papers for the house. And a lot of the banks would require that you have a current account with them before they can give you a loan. A loan can be a very useful tool to grow your business, own your home, or help you out of an emergency, but you have to be smart. Only borrow what you can afford to repay and only borrow for good reasons. That's the end of today's episode. It's your girl, Infinite Ngozi, bringing you another episode of You and Your Money, sponsored by the Bankers Committee. Bye!